As always, guys, this is just for entertainment purposes only. This is not financial advice.
Hey guys, and welcome back to my channel. I want to talk about Cliq Digital. Cliq Digital is a company I've been buying mostly around spring, but I still think it's heavily undervalued. In this video, I want to walk you through the valuations of this company and explain to you why I bought this stock. Guys, if you don't know Cliq Digital, they are a software company. They provide digital product, and right now their main focus is to go for some kind of Netflix, Spotify, Steam all-in-one service that you can buy quite cheap, I think for under €7. And they're going to launch on 2 European markets. I believe it's a German market, Cliq.de, and probably also the Italian or the Austrian market in September. So from the 1st of September, I'm really looking forward to that. So they're a relatively small company. They've been about 200 million in market cap, but they are super fast growing. So I wanted to go through the financials with you guys and show you why I decided on buying this company. Firstly, when I'm buying a company, I'm looking at 9 criteria that are important to me. I'm not going to say they're perfect, but the thing is, there's 50,000 stocks out there. I need to filter on something. So first, the PE, I want it to be lower than 25. The PE is 9, so that's great. That's a really low PE actually. Then the future earnings growth, the future 3 years earnings growth, because it's very hard to look 10 years into the future, but the future 3 years earnings growth is 20%. So that's pretty nice. The debt equity ratio, I want it to be smaller than 150%. So that's just a way of saying I don't want a company with too much debt. You could also look at the debt to free cash flow. That's another measure. I'm looking at the equity. Not really a reason, just the equity is probably more stable than the free cash flow. If it's going bad with the free cash flow, then it's probably going, then it doesn't matter how much or little debt you have if your free cash flow falls apart. Now, the dividend, I want to be larger than 1%. It does not need to be that large. I do like certain dividend, and if the company is growing, I expect that dividend to increase. So also here, 3.4 dividend currently. That's okay. That's a good dividend, especially considering we're predicting a 20% growth for this company. The next item I look at, it's the payout ratio, because I think if the payout rate is too high, perhaps the dividend is not going to be sustainable. So I want it to be under 40%. 40% is already quite high. I might actually decrease it in due time, but I think here 31%, that's pretty good. That's pretty nice. It means they're returning something to the shareholders. Also, buybacks would be nice. If you don't have a big dividend, then you need to have a nice buyout. Next, net profit margin, I want it to be higher than 10%. The margins, again, it shows, it's kind of like a statement of the moat, like if you have a high margin, it means you don't have that much competition. And here 11.41%, considering they're advertising themselves as the discounter in the streaming media market, I wouldn't expect a huge margin here, so I'm happy it topped 11%. The market cap, I want to be higher than 100 million. That's just for liquidity. It doesn't mean that I don't like a company of 50 million. I might actually lower this in the future, because I do think smaller companies can have value as well. And you have an edge on buying smaller companies, because those big hedge funds, they are staying away usually from the smaller companies, so they are better valued. Buybacks, it does not do any buybacks. That's not a red flag for me. No insider buying, but no insider selling either, so that's okay. Now, I'm going to value this company based on the stage 2 free cash flow to equity, which is sort of a discounted cash flow model. So I'm going to put some price targets depending of the growth. So we already know analysts predicting a 20% growth. but I'm valuing the company based on a 10-year projection, and that's why is 20% growth sustainable for 10 years? I don't think so. I don't think so. But on the other hand, they only have 2 million users, and I do think eventually they can have a huge amount of users. But it's really hard. I mean, it's a tough market, there's a lot of competition. So I'm decided to be conservative. I'm going to say 5, 10, and 15% growth, which they will easily have the 5% growth. I have very little doubt about that, and I think they will be on the high side of the growth, to be honest. I could add 20% just to show it, but let's go. So growth 5%. If I have a growth of 5%, what are my input parameters? So the risk-free rates, I look at the 10-year treasury actually. The risk premium, I give it 5%. That gives you a little bit of breathing space by putting a 5% risk-free premium. And then, yeah, the growth rate, I think that's probably the most important, the growth rate of the free cash flow, because I'm valuing this on the free cash flow. If I put a 5% growth, I get a price target of 69. By the way, the current price is 32. 32, guys. 32 is the current price. So, yeah, you can see that's a huge growth already. And that's on my most conservative growth rate. Now, if I say 10% growth rate, look at that, 102 euros, guys. If I put 15% growth, which was my top estimate, and then the price target is 150 euros. Again, it's trading at 32 euros. I do think it can get 15% growth, but I also think if it just gets 5% growth, I will make a lot of profit on this stock. Now, if we would follow more the analyst predictions, and I wouldn't say it's completely unlikely, I said 20% growth, then I'm getting a price target of 219 euros. I have stayed a little bit more conservative, but I don't think it's impossible. 219 euros. I think we could be there. Anyway, you have to do your own due diligence on this. If you like my videos, please like, please subscribe, and see you next time.